The U.S. national debt is quietly creeping towards an eye-watering $40 trillion. It's not just a big number, it's a looming wall that could reshape how the Federal Reserve thinks about your money and what happens next for markets. This isn't abstract accounting, it's a critical inflection point for global finance, and it carries real consequences for everything from mortgage rates to your stock portfolio. By the end of this, you'll understand why hitting this debt ceiling isn't just about government spending, but how it ties directly into bond yields, equity valuations, and even the future of the Fed's independence, especially with major signals coming from Jackson Hole. This milestone is about to test the very foundations of market stability. So, what exactly is this $40 trillion ceiling? It's the U.S. national debt reaching a level that many strategists see as a critical breaking point. Think of it less as a hard limit on borrowing and more as a psychological and economic proxy. It's a measure of the market's faith in the long-term stability of sovereign debt. That is, how much investors trust the government to pay back what it owes. As this number grows, the market gets jumpy. This isn't just about the Treasury, it spills over to the Federal Reserve. And all eyes are now turning to Jackson Hole, the Fed's annual economic symposium, where key figures like Kevin Warsh are expected to weigh in on fiscal sustainability. His words could send powerful signals across global markets. Why does this specific number matter so much? Because it creates an immense pressure point for the Federal Reserve. The Fed's job is to manage inflation and maintain economic stability. But as government debt climbs, the cost of servicing that debt, paying interest on it, becomes huge. If the Fed keeps interest rates high to fight inflation, it makes the government's borrowing costs even higher, potentially destabilizing national finances. This puts the Fed in a tough spot. Fight inflation aggressively and risk a fiscal crisis, or ease up to help the government, potentially letting inflation run hotter. The market is already signaling this unease, with rising bond yields pushing stocks to the brink. It's a delicate balance, and the $40 trillion mark amplifies this tension. Let's break down the mechanics. When the national debt pushes higher, it increases the supply of government bonds. To attract buyers for these bonds, yields often have to rise. Higher bond yields, in turn, make it more expensive for the government to borrow, and for everyone else too, from corporations to everyday people needing mortgages. This rising cost of capital then squeezes equity valuations, especially for growth stocks. Why? Because higher interest rates mean future earnings are discounted more heavily, making them less valuable today. And here's the kicker. If the market perceives that the Fed's ability to fight inflation is constrained by the government's borrowing needs, it can lead to higher long-term inflation expectations. That feeds back into bond yields, pushing them even higher, creating a self-reinforcing loop of pressure. So, what are the concrete levers to watch from here? All eyes will be on Jackson Hole, specifically Kevin Warsh's commentary. My read is that any indication he gives regarding the interplay between fiscal policy and monetary tools will be critical. Watch for language that suggests the Fed's future rate decisions might be constrained by the government's borrowing needs. If he signals a shift towards accommodating fiscal policy, then expect a re-evaluation of long-term inflation expectations and upward pressure on bond yields. If, however, he emphasizes strict independence and a commitment to fighting inflation regardless of fiscal implications, then the market might see short-term volatility but a clearer path for the Fed. Also, pay close attention to any discussion of quantitative tightening or balance sheet management in this context. Those are the specific signals that will tell us how the Fed intends to navigate this wall. A perceived weakening of fiscal discipline, or any indication that the Fed's stance is shifting, could have significant ripple effects. For equities, especially growth stocks, we could see valuations come under pressure as higher discount rates make future earnings less attractive. In the bond market, yields would likely continue their upward climb as investors demand higher premiums for holding sovereign debt. This impacts everything from corporate borrowing costs to your mortgage rates. In such a scenario, capital could flow into perceived safe havens or non-sovereign assets. If confidence in traditional instruments falters, investors look for alternatives. This isn't just about government policy. It's about a fundamental re-evaluation of risk across the entire market. This $40 trillion ceiling is more than a number. It's a flashpoint for how money and markets will move in the coming months. For a deeper dive into my full analysis and real-time updates on these signals, head over to Korra.finance.